Here you see the trades we did today, which is Thursday, May 11th of 2023 in our main option trading account. The first one is we closed out a butterfly position that we had started on Monday this week in NFLX. So you see that we bought to close two of the NFLX May 12th, which is tomorrow, 350 call options for 4.5 cents per share, and sold to close the NFLX May 12th, which is tomorrow, $340 call option. So let me show you why I did this, because it actually would have ended up being better if we had not closed it out when we did. But let me show you why I decided to go ahead and close it out when I did. So here you see the 1 minute chart for today. And we closed it out right in here. This is about half an hour after the market opened. So I saw that on the minute chart that it broke below the moving averages. And that's the main reason why I decided to close it out. We only had one more day after today until the option expires. So because of that, I decided to close it out. Hindsight, you can always make different decisions in hindsight, but as long as the decision was fundamentally sound, I'm okay with it being the wrong decision in hindsight, which we see, of course, today. Netflix had a great up day, went up 2.73%. So if you're still in this position, looks really good. It probably will end up hitting exactly where I thought it would tomorrow, around 350, if nothing wild happens in the market tomorrow overnight. But we did close it out. We walked away with a nice little profit of 49 cents, and we were only in it for basically for 2.5, 3 trading days. So happy to get that. And if you're still in it, I hope you get that $10 maximum profit. All right, the next one is in WDFC. So this was a multiple leg order, but what we basically did, let me go, so you see we pocketed $3 per share. Now let me show you what we did here. So this is a position where we have a cash secured put option. We also have a covered call in WD40, and we've been selling a bearish call credit spread. So WD40 has advanced nicely over the past couple of months, as you see here. It's really making big market swings. It's here in an upward sloping trading channel. This channel is pretty wide. Notice that it's around the bottom of it now is around, let's see, around 175, and the upper portion is around 205. So it's about a $30 wide trading channel, and it's definitely in a bullish channel here. We see that on the daily chart. Looking over at the weekly chart, again, we see nice buying pressure. We see that it broke out above the 200 moving average. It did come back down, found support the green 50 moving average on this weekly chart. Now this week so far, it's been a nice strong green candle. We of course have one more day left to go. It hasn't retested the bottom of this channel yet, so it wouldn't surprise me if it did, but so far this week looks like it's going to be very strong. Now it did test the upper part of the channel, as we see right here, yesterday and again today, and it came down. So we got our order filled today, and what we wanted to do was we basically wanted to roll our short call options up. So we bought the May 19th, which expires a week from tomorrow, 160 call option. And we went out, we had to go out to August, but we rolled that call option all the way up to 180. So rolled it up by, let's see, rolled it by $2, if I remember correctly. Yep, rolled it by $1. So we bought the May 160 and sold the August 170. So rolled that one up by $10. Then also did the same thing with the bearish call credit spread that we've been in. We bought the May 19th 180 call and rolled it up to the August 18th 190 call. So rolled both of us short call options up. Remember, we're in a covered call position. To help fund that, we sold the August 18th 180 put. And notice that 180 put, it's right here at the red and green moving averages on this daily chart. And it's also right here at the green 50 moving average on this weekly chart where it found support last week and then also this week. So that's our position. We adjusted. We got the call options up, which is what we want to do. Ideally, we'd love to have the bearish call credit spreads expire worthless, but we'll see what happens over the coming months. All right, and then with the U.S., they're having a hard time, like normal, reaching an agreement between the different parties, political parties, which it always happens, and they always push it right to the end. But just in case, I thought we'd just spend a couple $100 here and buy some insurance. Do I think that they'll come to an agreement? I do. I put a poll out there on my YouTube channel. If you want to vote on it, go ahead and go to the community tab on my YouTube channel and vote on the poll. And just asking, do you think they'll come to an agreement before we reach default? I think they will. They always have, but every time that they've done this, it seems like it gets closer and closer to when we will default on our debt, and sooner or later they're going to get caught. So I decided to go ahead and spend a couple $100. I think it was around $260, including the 5-cent cost of buying the call options and 35-cent commission. So we bought the UVXY. So let me pull this chart up here. UVXY. We bought the $15 call option. So one thing I want you to really look at, and I have a video coming out Saturday at 8 a.m. Eastern that will talk about how to protect your portfolio in case of government default. So be on the lookout for that. But notice that there is a huge huge drop in UVXY over the time period that's been trading. And that's just how this ETF is designed. It's designed to do that. But what it's really good at is capturing high volatility moves. So notice if we go back to, we're looking at the monthly chart here, and it's a little preview of my video for this weekend. Notice that going back to the COVID crash, that it was trading for around $132. And notice that it spiked all the way up to $1,300. So basically it went up 10 times, almost 1,000% over those few months. So my thinking is, if something wild were to happen, like the government were to default on their debt or something, well, we're in a position where UVXY, it's currently trading for $3.50 per share. It could go up by 10 times. So it could go to $35. Now, we bought the $15 call, so if you back that out, then you see that we'd have a profit of about $20 per share if it ended up at or above our strike and ended up at that $35 area on expiration. So we have 4,500 shares, so you multiply that times 4,500, you see that we have a profit of about $90,000. So we basically are spending $260 just in case, which I think is very unlikely. I'd give it a 2 to at most 5% chance that the U.S. has a debt issue that they don't work through before they default. But there is a slim chance. So is it worth it to spend $260 for something that may not happen? Well, to me, I feel like it was worth it. So that's why I went ahead and bought this cheap insurance. So now we'll see what plays out. We have until June 16th for this to pay off, and hopefully they'll get it figured out before then. The next one is our Disney position. Disney announced earnings and had a pretty good drop today. So let me kind of talk you through what we did here. So first of all, notice we pocketed 87 cents per share. Okay. Now we bought the Disney May 19th $95 cash secured put option, and then we rolled that down and out to June 16th 90. So we got it rolled down by $5. We're also in a poor man's covered call. So we'd sold a call option. We had sold the May 19th $100 call, and because of the weakness, I decided to go and roll it down and out to June 16th 95. So we rolled both the cash secured put option and the short call option, short near-term call option, that's a part of our poor man's covered call, down in Disney. Let's just take a look at the chart here. So we see that Disney, it had a big drop today from where it closed last night to where it ended up at today. We see it's about an 8.5% drop. We see here 8.5%. So very likely that Disney will try and come back and fill this gap. Notice that when it had a gap back here in November, it had a big gap and it worked its way back really fast. That could happen again. And that's one reason why I didn't roll our call option down to 90, which would have been a little bit in the money. I rolled it down to 95. But I also got our put option down. So our put option is right here around what found support back in May. Found support there. I'll see it found support back here in December, and also some support back here in November. So an area where it should find support, but it continues to decline, although it was a very big red volume day today. So we'll have to see what happens over the next couple of trading days, if it'll stop here on 90 or keep going lower. But it has a nice gap there, so will it try and fill that gap? Well, it might, and that's why we went ahead and sold the 95 call and the 95 put. That gives us more room to the downside to be profitable on our put, and also gives us a little bit of room for it to go up from 92.5 to 95 on our call option, and it's still not going the money. So we'll see how the next month plays out. We were at a pocket 87 cents per share, so we like that. Our final trade is a new one. It's in TROW. We sold the June 16th $100 cash secured put option. So we're waiting on TROW to announce earnings, which it has now announced earnings, and we're looking for it to come down in an area where we got sufficient premium and it looked like it was finding support, and that's what happened today. Now the negative we see on the hourly chart is trading below both the green 50 red 200 moving averages. So don't really like that, but it's not a big deal when the daily and weekly look interesting. But one thing I do like here in the hourly or 60-minute chart is that it's basically been trading sideways ever since May 2nd. So about 9 days now, it's been basically trading sideways. And we see that over here in a little bit smaller area in our daily chart. So it's basically traded sideways since that same day, May 1st or May 2nd. Now we see that several times the sellers have come in and pushed the stock down. But when they do, by the end of the day, the buyers buy it back up. So we really like that because it's telling us that buyers get really interested right around this 103 area. So we like that. And coincidentally, that coincides with the area back here in March, the middle of March, where it found support a couple of times. And it did that on pretty high volume. So again, we see nice volume on 2 green days here. Now, keep in mind that overall, TROW is in a slightly downward sloping trading channel. We see it made lower lows back in that March range. So it is in a downward sloping trading channel. Not a steep one, but it is a downward sloping trading channel. However, as it was declining over the past couple of weeks, we see volume was also declining. So sellers were getting weaker and weaker. Then buyers stepped in and bought it up a little bit. It declined. They bought it up a little bit more. And every time we're getting around this 103 area, buyers are coming in. So will it continue to hold? Well, we'll see if it does. But we do have some room for it to come down. It can come down $6 more from where it closed today, all the way down to 100 before our $100 strike price is challenged. Now looking here at the weekly chart, we see buyers were really strong a couple months ago. Last week, sellers showed some great strength. So far this week, we have one more day. The volume is a lot lower than last week. So does that mean that sellers' excitement has diminished? Well, it does appear that way. So it's a position I'd love to add to if it continues to find nice support and the return stays sufficient. So that's our trades for today. I hope you have a great evening.